Welcome everyone to a new episode of Finance in Focus. We are the podcast team from the ESFS Student Finance Society, and we are very excited to bring you in-depth insights on the latest economics and market developments. I am Laia Marçal, and joining me today, we have our amazing team members.
Good morning, everyone. I am Laura, and I will be covering the most recent global and macroeconomic perspectives. I will also focus on how commodity prices are influenced by inflation and supply chain disruptions.
Hello, my name is Francesco, and I will walk you through markets performance, summarizing the key movements in global indices. I will also dive into equity research, analyzing a top-performing company, discussing its recent performance, financial results, and future outlook.
And I am Tony, and I lead our Insights Spotlight discussion, exploring a major financial trend in depth. I will also provide the week ahead, offering insights into upcoming economic data releases and other key events that could shape the markets.
Well, we've got a full agenda, so let's get started. Well, to start things off, let's welcome Laura, our go-to expert on macroeconomic events. Let's jump into the latest updates on global markets, trade, and monetary policies. Can you please start by giving us a sense of how global economic growth is shaping up?
Sure, so at the moment, global growth is facing renewed challenges. The OECD has recently revised its global growth forecast downward. They now anticipate the world economy will expand by 3.1% in 2025, with a further slowdown to 3% projected for 2026. A key factor contributing to this more cautious outlook is the increase in trade tensions. Protectionist measures are becoming more widespread, and this is starting to place significant strain across border commerce.
That rise in protectionism is certainly concerning, especially for economies that depend heavily on international trade. Well, shifting focus to the United States, how are growth prospects evolving there?
Okay, so the United States is also facing a weaker growth outlook. GDP is expected to decline from 2.8% in 2024 to 2.2% in 2025, with further cooling anticipated in 2026. This turndown is being driven by a combination of persistent trade disputes and uncertainty surrounding fiscal policy. As a result, businesses and investors are increasingly cautious, reluctant to make significant commitment in an unpredictable environment.
Well, understandably so. When there's that level of uncertainty, prudence often prevails. Turning to monetary policy, how are central banks responding to these developments? Perhaps we can start with the Federal Reserve, for example.
Sure. So the Federal Reserve has opted for a steady approach. They have indicated that interest rates are likely to remain unchanged until at least mid-2026. It is a delicate balancing act for policymakers. On one hand, they aim to keep inflation under control, and on the other, they worry about tightening policy to the point that it undermines economic growth. For now, their stance is to maintain stability and monitor conditions really slowly.
Well, a cautious, measured response, it seems. And what is the situation in the United Kingdom? How is the Bank of England navigating these challenges?
Okay, so the Bank of England finds itself in a similar position. Despite slowing growth, inflation in the UK remains elevated. As such, policymakers are hesitant to lower interest rates. Compounding their concerns are the potential effects on the US, tariffs on the UK economy. Markets are paying close attention to the bank's upcoming decisions, particularly whether they will maintain rates at 4.5% in their next meeting.
So caution seems to be the prevailing theme among central banks on both sides of the Atlantic. However, beyond the economic indicators, policymakers are also navigating rising geopolitical tensions, adding another layer of complexity to the global landscape. Could you share the latest on this front?
Okay, perfect. So, on geopolitical developments, they have indeed intensified lately. In the Middle East, the ceasefire between Israel and Hamas has collapsed. The conflict has escalated significantly, resulting in considerable casualties and heightening concerns about border regional instability. Such developments tend to make investors more risk averse, and we're already observing the impact in the financial markets.
Oh, yes, markets often react swiftly in times of geopolitical uncertainty. Have we seen this reflected in commodities and currency markets as well?
Yeah, totally. First of all, in gold, which is traditionally seen as a safe haven asset, it has been a remarkable surge. Prices have broken through the 3,000 per ounce threshold for the first time in history. Investors are clearly seeking for refuge aimed rising geopolitical risks and unresponded to trade disputes. On the currency front, the British pound has shown notable strength, climbing past 1.30 against the US dollar, its highest level since November. This movement is partly due to the weakening of the dollar as traders factor in concerns regarding the US economic outlook and the possibility of future interest rate cuts.
It appears we are witnessing a broad flight to safety, with markets positioning themselves defensively. Looking ahead, do you foresee any unexpected developments in upcoming policy meetings that we should be mindful of?
It is certainly possible. Given the complexity of the current environment, central banks may need to adjust their policies in response to the evolving conditions. Any unexpected decision, whether from the Federal Reserve, the Central Bank of England, or other major institutions, could have significant implications on the market. It is a dynamic situation that warrants close attention.
Indeed, it sounds as though we are in a period of heightened vigilance and cautious decision making. Well, thank you so much for that, Laura. Now, let's shift gears and hear from Francesco, our specialist in global market trends and equity analysis. He's here to unpack recent market movements and share his key takeaways from the latest equity research.
Okay, thanks. Laia, there has been a great deal of discussion surrounding recent market volatility, much of it tied to policy decisions both in the United States and abroad. I'd like to begin on focusing on small cap stocks. They've exhibited significant fluctuations over the past decade, much of it seemingly tied to former President Trump's economic policies.
Could you provide some context on this development?
Certainly. So, small cap equities experienced considerable volatility in recent years, largely in response to policy shifts during Trump's administration. Early on, these stocks benefited from substantial tailwinds, particularly following the passage of the 2017 Tax Cuts and Jobs Act. That legislation reduced the corporate tax rate from 35% to 21%, delivering disproportionate benefits to domestic small cap firms, which tend to generate the majority of their revenues within the United States. As a result, investors' interest surged, driving small cap indices to historic heights.
Well, indeed, it was a significant period of growth, but that momentum wasn't sustained. What factors led to that downturn?
So the introduction and escalation of tariffs played a pivotal role in undermining that earlier momentum. Initially, small caps were perceived as relatively insulated from global trade disputes because of their limited exposure to international supply chains. However, as tariffs broadened and input costs increased, these firms lost their competitive edge. By 2019, small caps were significantly underperforming large caps, particularly within the technology sector. This shift reflected a broader atmosphere of policy uncertainty and increased risk aversion among investors.
And tariffs are once again taking center stage. How is this renewed focus impacting markets today?
So tariffs have become a key focal point in the US trade policy once again. Recently, the US has increased import duties on a range of Chinese goods, 100% on electric vehicles, 50% on solar panels, and 25% on critical technologies and metals. These measures aim to protect key domestic industries like clean energy and advanced manufacturing. However, they've significantly heightened trade uncertainty, complicating long-term strategic planning or for businesses. Many companies are delaying capital expenditures and investment decisions due to lack of policy stability, which has contributed to a 4 trillion stock market sell-off. While protectionist policies may offer short-term relief to select sectors, they've also fueled market volatility and undermined broader investor confidence.
Well, we have already seen that volatility reflected in the broader indices, correct?
That's right. The S&P 500 fell by 2.7% on March 10th, closing at 5,614.56, before staging a modest recovery of 0.6% by March 17, ending the session at 5,648.29. The Nasdaq Composite experienced even sharper moves, dropping 4% on March 10 to close at 70,046.8.32. While there was a slight rebound of 0.3% by March 17, tech stocks remain particularly sensitive to trade policy shifts and fluctuations in consumer demand. Investors are closely watching for signs of policy clarity, but in the meantime, volatility persists.
Interestingly, European markets seem to be holding up a bit better. What's behind that relative stability?
So, European equities, represented by the Stocks Europe 600, have posted modest gains, advancing 1.1% in recent sessions. Much of the resilience can be attributed to Germany's announcement of new fiscal expansion initiatives aimed at stimulating economic growth. However, these initiatives have also raised concern about the public debt. Germany's 10-year bond yield has increased by 23 basis points, now at 2.72%, indicating heightened sensitivity in European bond markets. While the equity markets are showing stability, debt markets remain cautious.
And how are Asian markets reacting to these global pressures?
Performance in Asia has been mixed. The Nikkei 225 has shown volatility, reflecting concerns about both global trade extensions and domestic economic conditions. In contrast, Hong Kong equities have outperformed, supported by China's announcement of a 5% GDP growth target for 2025. This has raised investor expectations for additional fiscal stimulus from Beijing, which may help offset some of the prevailing uncertainty tied to global trade and slowing external demand.
Well, in light of these developments, how are asset managers adjusting their strategies to navigate this complex environment?
So, asset managers are adopting a cautious yet flexible approach. In the short term, over the next 12 months, the priority is clearly on risk management. Defensive equity allocations are being emphasized, particularly in sectors like utilities, healthcare, and consumer staples, which tend to be more resilient during economic slowdowns. On the fixed income side, managers are favoring short duration bonds and inflation-protected securities, especially in regions where central banks are pivoting toward monetary easing. Gold continues to be viewed as an effective hedge against both inflation and geopolitical risks. Additionally, selective exposure to high-quality corporate debt is offering attractive yields without excessive risks.
Well, and what about the medium and longer-term positioning?
So, over the medium term, spanning on 2 to 3 years, managers are beginning to cautiously reintroduce risk into their portfolios. Mexico stands out as a major beneficiary of the US nearshoring trends, with industrial and infrastructure stocks gaining traction. Similarly, Brazil and Chile offer attractive opportunities as inflation moderates and structural reforms continue. Private equity is also gaining interest, particularly in sectors such as technology, fintech, and logistics, where ongoing digitalization and supply chain shifts are creating compelling investment opportunities. For long-term horizons, beyond 3 years, structural growth are dominating investment strategies. Latin America's commodity sector, especially copper, lithium, and energy infrastructure, is a key focus given the global transition to renewable energy. Real estate and infrastructure investments in logistics hubs, particularly in Mexico, are also seen as attractive, providing inflation-linked returns and portfolio stability. Many managers are increasingly turning to multi-asset strategies, blending emerging market credit and private investment to balance growth potential with downside protection.
Perfect. Well, before we conclude, I'd like to touch on the recent leadership change at Intel, which has drawn a lot of attention. What's your assessment?
So, Intel has indeed made headlines with the appointment of Lip Bu-tan as its new Chief Executive Officer, succeeding Pat Gelsinger after a difficult tenure. Investors have responded positively. Intel's stock rose by 8% following the announcement. The company has faced considerable headwinds, reporting its first annual loss since 1986, with an operating deficit of 19 billion in 2024. Over the past 5 years, Intel stock has lost around half of its market value, falling behind major competitors like Nvidia and TSMC.
Well, and how is Mr. Tan expected to steer Intel moving forward?
Mr. Tan has made it clear he intends to accelerate execution rather than implement a sweeping overhaul of Intel's current strategy. His focus will be on expediting innovation in chip manufacturing, streamlining Intel's historically slow decision-making processes, and carrying out necessary operational reforms. AI chips, our foundry services will be key areas of emphasis, as Intel aims to regain lost ground in these high-growth segments. While the challenges are formidable, if Mr. Tan delivers on these objectives, Intel will be poised for a significant turnaround.
A pivotal moment for Intel indeed. Well, big thanks, Francisco, for those insights. Next up, let's bring in Tony, who will be taking us through our Insights Spotlight segment. He will explore a major financial trend in depth and give us a look ahead at the critical economic data and events to watch in the upcoming week. This week, also, we're not focusing only on one single financial event or news headline. Instead, we're opening up a much broader, deeper question, one that's on the minds of many investors lately. So, Tony, what are we talking about today?
Well, a question, not a headline. Is AI a bubble? Exactly, Laia. This episode is not just about the latest earnings release or a sudden market shock. Today, we want to pause the noise and explore something even more fundamental. Is AI, artificial intelligence, becoming a bubble, or are we witnessing the early days of a new economic era? And I think this question, Laia, matters because we've seen this before. We've seen that happens when innovation meets speculation, and history is full of lessons. Okay, so let's take a step back. By taking a step back, we can see that looking back, we can see looking forward. Okay, so we will see the nature of bubbles. Think about the first one, the dot-com bubble in 2000. The internet was revolutionary, but not every dot-com company deserved billions in valuation. The bubble popped, but from its ashes rose Amazon, Google, PayPal, companies that defined the next 2, even 3 decades. The second one, the clean tech boom in 2007 and 2009, same story. Hype ran faster than fundamentals, but in the long run, we got Tesla, next era, and a serious green transition. And more recently, Laia, these crypto bubbles of 2017 and 2021, which wipe out speculative markets and capital, but still gave birth to real infrastructure and new financial models that are evolving today and nowadays. So when we ask, is AI a bubble? Maybe the better question is, does it even matter? Because bubbles often act as accelerators. They push capital, ideas, talent, and yes, sometimes hype, towards future.
But why are people calling it an AI bubble now?
Laia, let's be honest, the signs are always there. You just have to look for them. Companies like Nvidia trading at price to equity ratios above 60, a stock like super microcomputers multiplying by AX in literally 12 months, less than a year. Every startup now claims to be AI powered. Even companies with zero AI integration are being rebranded just to attract capital or investors. We've entered a phase where valuations multiples are going faster than revenue projections. That's like a dangerous ground, don't you think? But the thing is that, and here's the twist, AI is not a fantasy. It's real. It's something happening. It's already being deployed in, firstly, banking and credit scoring. Secondly, fraud detection systems. Thirdly, portfolio automations and trading algorithms. Even in wealth management and robo-advisors, we can see AI integrated. The problem, Laia, isn't the technology. It's the expectations around it, like always. So maybe we're not in a technological or technology bubble, but a narrative bubble. And those are just as powerful and risky.
Well, thank you, Tony, but what should young investors really think?
Well, I think this is especially relevant for us, young investors, students like us, future professionals, because this moment right now might define how we approach risk and opportunity for the next decade or even the next 2 decades. History shows, as we've seen, that in every bubble, in every single bubble, some people get burned chasing hype. That's a fact. Others wait on the sidelines forever and miss transformative trends. There's actually a metaphor, but a few, those who understand timing, execution and strategy, invest in the right projects at the right momentum, at the right time, and become the ones building the future. Because people we thought before are the people building now. So maybe this AI rally needs to cool off a little bit, maybe even burst a little, to separate what's real from what's the noise. That's okay. Sometimes bubbles have to burst, not to destroy, but to consolidate and reset. But like, if you're paying attention now, watching, analyzing, learning, you'll be in a better position when the real shit happens. But as a final thought for the listeners, I would say just catch the right train at the right time. I leave you with this metaphor I mentioned before. The metaphor goes like, in every cycle, there are people who miss the train, people who jump on the wrong one, and people who spot the right one at the right times. And those, my listeners, those are the winners. And the company you believe in today, maybe that company, the one you analyze while you are still at university, could be the company the world is talking about in the next 10 or 20 years. Or maybe it will be forgotten, we don't know, in a year when this hype fades or goes away. But that's the beauty of it. You get to choose where to stand, you don't need to rush, but you do need to think. Now, Laia, moving a little bit to the week ahead earnings, macro data and market watch.
Yeah, well, Tony, thank you so much for that perspective. It really puts things into context. But as you just mentioned, let's take a look at the more concrete part of the week ahead. What are the key themes on the radar?
Well, absolutely. Here's what's worth watching this week. So firstly, as a earnings highlights, I would say Oracle on March 26th, focus on AI cloud infrastructure revenue. Investors want to know if the AI narrative we mentioned is turning into those tangible growth. Secondly, Micron Technology on March 27th, a key player in AI hardware that some may not know, memory chips. This will be a good indicator of real demand behind this AI boom. Also, Lululemon on March 28th, so not tech, but still important. If luxury consumers are pulling back, it might hint a broader shift in consumer confidence, actually. But moving a little bit into macro data, US consumers' confidence. These Tuesday markets expect a very slight dip. A sharp fall could push the Fed rate cut expectations a little bit higher. The US GDP final quarter 4, Thursday, a reading below the expected 2.9% would pressure equities. A surprise on the upside could support market strength. Also, the core PCE price index on Friday, the Fed's favorite inflation metric. If inflation cools faster than expected, then the Fed expects tech to rally again. Moving a little bit into geopolitical and policy watch, US-China relation tech tensions are back on the table. They are back on the game, especially regarding semiconductor controls. Moving a little bit forward, Middle East energy risks remain a wildcard affecting commodities and inflation expectations.
Thank you, Tony, for that valuable insight into the latest financial developments and what to expect in the coming week. Now, turning our attention to something a bit more local, let's talk about how the ESFS Student Finance Society is opening doors for students to enhance their finance and investment expertise. One of the ways we do that is through our research department, where students dive deep into real-world financial topics and produce high-quality reports covering key areas of the market. The team has published a series of new reports offering fresh insights into the global economy, M&A deals, and equity markets. Starting with the economy subdepartment, they've released an in-depth report on Argentina's debt crisis. It explores decades of economic mismanagement, high inflation, and repeated defaults. The focus is on President Javier Milei's radical reforms, cutting public spending, privatizing state companies, and potentially dollarizing the economy. While early signs show lower inflation and a stabilized currency, poverty levels have surged to record highs. The report highlights both the progress made and the significant risks that remained for Argentina's future. Over in the M&A subdepartment, there's a report on General Motors' full acquisition of Cruise, its autonomous vehicle subsidiary. After years of heavy losses and regulatory challenges in the robotaxi sector, GM decided to fully integrate Cruise and shift its focus towards enhancing its driver assistance system, Super Cruise. This move is aimed at cutting costs, streamlining operations, and strengthening GM's position in personal autonomous vehicle, where it will compete more directly with Tesla and Waymo. The robotaxi dream may be paused, but GM is now bidding one more immediate opportunities in assisted driving technologies. And finally, the Equity Research Subdepartment has just published a report on Reddit. The team initiating coverage with a buy rating, citing Reddit's strong user growth and rising advertising revenues. The report also highlights Reddit's strategic push into data licensing for AI training, with key partnerships already in place with OpenAI and Google. Despite its high stock volatility, the team sees solid long-term potential, thanks to Reddit's unique community-driven model and its expanding monetization strategies. All these reports are now available on our LinkedIn page and on our website, so make sure to check them out if you want to dive deeper. So, let's wrap up this week's episode. On the macroeconomic front, global growth is slowing, trade tensions escalate, with the OECD downgrading forecasts and central banks like the Fed and Bank of England holding off on rate cuts amid persistent inflation and geopolitical risks. In equities, renewed U.S. tariffs on Chinese goods have triggered market volatility, with small cap and tech stocks under pressure. Meanwhile, European markets show resilience, and asset managers are cautiously balancing defensive plays with emerging opportunities in Latin America and Asia. Finally, in Insights, we explored whether AI is entering a bubble territory. While valuations are high, the technology's long-term potential remains significant, making it a space to watch closely. Looking ahead, key earnings from Oracle and Micron, along with U.S. inflation data, will be in focus as markets navigate this complex environment. As always, staying ahead of these shifts is key to making informed decisions. Thank you for tuning in, and we will see you next week for more insights and analysis.